All right, everybody, welcome to the show. We're live on Facebook and YouTube and Periscope. Welcome to the Real Estate Connection. We're recording the radio show for Saturday after the Super Bowl, and I have in studio with me today uh, Ruth. That's right, Ruth Benjamin. She's a tax strategist. We're going to talk about avoiding taxes on the sale of real property today. So bear with me as I forgot my baseball hat and I'm just wearing my cowboy hat today, so my headphones are a little wonky. I may be doing the old radio thing like this to keep them on, so bear with me. So Marco's going to spin us up with the music, and we're going to jump into today's show. And let me know if you can hear. Let me know if the paper rustling is too heavy and all that good stuff. And I'm going to move this over just a little bit. So yeah, we got more of Ruth in there. Here we are. That's better. That's a better shot.
All right.
All right. So we have our studio set and we're ready to go. All right, Marco, whenever you want to spin up the music, let's get going. One of these days I have to figure out how to spin this music on live because we're boogieing down to it on stage. Yeah. Oh, yes. It's a good week. It's a good week. That's right, seasoned investors, this program is for you. Yeah. You know, they asked me to pick music for the show, and I thought this was pretty appropriate. Are we good? All right. Hey, good morning, good morning, good morning. Welcome to the Real Estate Connection on KFAX 1100 out of San Francisco, Oakland, San Jose, and my South County friends in Morgan Hill, San Martin, and Gilroy. Thank you for joining me this morning. I'm glad you could make it. I hope you all had a fantastic week and a good weekend. The Super Bowl is officially over. And for all of my 49er fans out there, it was a tough loss, but hey, I'm sure they'll be back next year. There's always next season. We want to thank the 49ers for what a spectacular performance that they had. We are NFC champions for 2019 for sure. And we have a good solid foundation and a base to proceed into the next years. However, you know, this time of year is traditionally when what was I going to say? I got lost in my notes. Oh, however, with the Super Bowl officially over and in the books for 2020, I apologize. You know what? Sometimes I'm like looking at my notes and I get lost and I skip ahead. But I know, right? Okay, so however, with the Super Bowl officially in the books for 2020 and the spring real estate buying and selling season has officially begun or started. This is traditionally the time of the year when wives can get their husbands off the couch to go out and look for houses because there's no more excuses to say, honey, no, the game's on. Football's over and there are plenty of basketball games, and unfortunately the Warriors aren't doing so hot this year, and there's hockey, and baseball is yet to begin as the spring moves forward. However, traditionally is this time of year right after the Super Bowl is when the buying and selling season starts in real estate. And so traditionally, this is when sellers can attract the most qualified buyers and get the most money from their home or rental property, because not only do we have sellers out there looking to maybe move up, move down, or transition into a better area or a new area, we also have investors that may be looking to sell off their duplex, triplex, fourplex, or rental property, because this is the hot time of the year when you have traditionally in the market the most qualified buyers who are chomping at the bit and ready to go. So, however, in today's show, we are blessed to have with us in studio Ruth Gaines to educate us on how to avoid or hold off the tax man for up to 30 years on the sale of an investment property or your primary residence, and to talk about something called 1031 exchanges. That's when you can sell your investment property and avoid the tax man, but it's very specific and detailed, and we have a person in studio today who's an expert in the field who will be able to walk us through. So hopefully she will be able to bless you with this information. And speaking of blessings, I would like to bless you if you email me for a no obligation appointment to give you an estimate on the value of your home, or just to sit down to discuss the prospect of buying a home. I have a gift for you. I'd like to give you a copy of a book called The Family Preparedness Buyer's Guide. This is a must-have book for any family preparing for any emergency. This bestseller will provide you and your loved ones with information on the best survival gear, tools, and weapons for your skills and budget. Chapters include emergency shelter, fire and clothing, because it gets cold out there, emergency food and cooking gear, because when the lights and power are off, you traditionally do not have the ability to cook as normal, and communication and navigation. We may have cell towers down, so how to communicate and navigate when you don't have your GPS available, and weapons, as in self-defense weapons, handguns, and rifles. I have a copy of this book, and it's very easy to read with lots of useful information. Now, here's a little back. You know what? I am off today. You know what? I have a guest in studio, and I usually am on a roll, but I'm off today. And my notes have changed to accommodate my guests. So I have a copy of this book for you if you email me at info@realestateconnectionradio.com. Again, info@realestateconnectionradio.com. Now, let's get down to business. In studio today, I have a very special guest, as I've already mentioned. Her name is Ruth Benjamin. And here's a little background bio on our guest. Ruth has a passion for helping sellers of highly appreciated assets sell their property without paying capital gains taxes at the time of sale. Ruth's role is to educate sellers on the various strategies available. There are some IRS-approved methods to accomplish tax deferred sales. From there, Ruth connects her clients with the appropriate professionals who can analyze their situation, give advice based on their individual circumstances, and help deploy the strategy that best fits their situation. Ruth has over 25 years of IRS Section 1031 exchange experience, and she was the president of 2 different companies. So with that, welcome to the Real Estate Connection, Ruth.
Thank you.
I know, that was rough. That was rough, but we got through it. How are you today?
I'm great. How are you doing?
I'm doing great. Welcome to my little studio here at KFAX.
I love it.
Yeah, you like it?
Mm-hmm.
Yeah, I'm experimenting here with broadcasting live. I've created my own little set, my own little virtual set. Today we're going with a background of bricks. Looks a little industrial, but since we were talking about real estate, I thought it would be appropriate.
Brick and mortar.
Brick and mortar, that's right. Brick and mortar, baby. We're either selling them or living in them. All right, so I've already asked how you are today, so let's go on to the next background question. Are you a native to California?
Yes, I am. My family is from Minnesota. I'm the youngest of 9 children, and my twin sister and I are the only ones born here in California. I've been here my whole life.
Wow, that's great. So that makes 2 of us. I was born in Monterey, California, and grew up part of my life in the Carmel Highlands, and then moved down to San Jose at 6 years old with my mom, and have lived in San Jose in the Bay Area ever since, and moved to the South County in 1999, right around Y2K. I remember when I was moving, everybody was afraid that
our money was going to disappear out of the banks.
Exactly, right? All your money was going to be gone. Your computers were not going to work anymore.
That's right.
The whole world was going to come to a crashing in. Oh my Lord. So anyway, how did you get into the business of consulting on deferring or avoiding taxes on the sale of real property?
Well, I got into 1031 exchanges actually from a friend back in the 80s. Brought me into this company and taught me how to do 1031 exchanges. And then I met a lady 4 years ago that told me about the monetized installment sale. And I was so excited about it because I knew this was a way for investors to exit 1031 or just different ways to work around it. So very, very excited to give you this information today.
Yeah, I'm excited to hear it. So to be honest with you, she sent me some information beforehand, and I read up on it, and I was in shock. I was like, what? This exists? How come I haven't heard about it? So I'm super excited to share it with you guys today. So what company are you currently with?
I'm with Financial Tax Strategy, and I work with National 1031 Exchange for the 1031 exchange end of it.
Okay, great. So she's with National Tax Strategy. Marco says I have a minute, which probably means I have 30 seconds. So we're going to go to a hard break here. And when we get back, we're going to get into a little bit more of Ruth's background and whether or not she enjoys what she does. And then we're going to jump into these strategies to avoid tax or to defer tax on the sale of real property here in the state of California and nationwide. So stay with us, grab another cup of coffee, grab a pencil and paper to take notes because you're going to want to get as much information as you can, and we'll also provide details on how to contact Ruth directly during the show. So we'll be back in a minute. All right. This thing's driving me crazy. I might have to lose the hat. Sorry. There's my bare head. I know you don't see it often, but here we go. There we go. Oh.
It's not bare now.
It's not bare. It's not bare, but you know what? It is what it is. So, do I have anybody in? No comments today. All right. That's okay. That's okay. This is going to be recorded and we'll pop it up on YouTube and you guys can watch it again. Don't forget to hit the like and subscribe button. Hit like and subscribe and share it with all your friends. And with that, I'm going to ask my producer, Marco, to play the intro music as we jump back into the show. Hey everybody, welcome back to the show. Thank you for joining me this morning on the Real Estate Connection with your host, Stephen Thayard on KFAX 1100, San Francisco, Oakland, San Jose, Morgan Hill, San Martin, and Gilroy. And if you're having a hard time catching us through the airwaves, you can find the show on iHeartRadio.com and iHeartRadio.com or the app. So feel free to tune in that way as well. On today's show, we have a special guest with us, Ruth Benjamin, who's an expert at 1031 exchanges and monetized installment sales. And that's just big words for not paying tax or deferring paying tax for a long period of time when you sell real estate that you've made money on or you've used as an investment property. And before we went to the break, we were speaking to Ruth about her background. She was saying which company she worked with and that she's a native to California. And then she was telling us how she got into the business and what company she's with. So my next question is do you enjoy what you do?
Oh, I love what I do. If I can help somebody not write that check to the IRS and be able to keep it in their portfolio, it's very exciting.
Yes, and I can tell you as a person who's had to write very large checks to the IRS, it is no fun. It is no fun at all. It's a blessing. It's a blessing that you have the money to do it, yes, and that, you can pay your financial responsibilities. But watching all that money go out the door is heartbreaking, especially when you've worked so hard for it. So for those who may not be familiar with capital gains taxes on the sale of real estate, can you explain how a homeowner or investor is taxed on the sale of their real estate when they go to sell it?
Well, when they sell their property on an investment property, there's 20% federal tax, 13.3 state tax, and 3.8 net investment income tax, which people know better as Obamacare.
Okay. Oh, that's right. Obamacare touched the sale of real property too?
Yes, it does.
I had no idea.
So you have to remember that part, 3.8 additional to take care of that.
So repeat that again, because just
20% federal.
20% federal, okay.
13.3 state.
13.3 state, that's the state of California.
3.8 net investment income tax, which is Obamacare.
Oh, my Lord. So 13, that's like 25%.
At least. 27?
27%.
Well, actually, it comes out to 30, almost 30, because
that's
you have
right.
20, 30,
13.
36, about 37%.
37% on your money. On your money. And
off the top.
Off the top. So that's eating into your profits and potentially your principal, because we haven't even brought up what's it called? Depreciation recapture. That's
25%.
That's an ugly term that needs to be obliterated from the taxes, from the tax rolls, from the law, everything. Depreciation recapture. And a lot of people don't know what that is. So we may get into that too. All right, so do investors, so we have two different types of property owners. We have owners of primary residence, so that's for all you people out there that own your own house, and then you may also have an investment property. Maybe you have a house in Lake Tahoe or a vacation home, or maybe you just have a rental, or maybe you inherited a property from a loved one that's now become a rental. Do investors get that $250,000 to $500,000 exemption that primary homeowners get when they sell their homes?
No, they don't.
So they don't. So we're talking about just straight taxes on the sale of the investment property.
Right, and a lot of people still believe to this day, a primary residence owner, the one you live in, that if you sell your property and then you buy another one equal or greater to what you sold, you're okay. That doesn't apply anymore. You get $250,000 exclusion for a single person, $500,000 for a married couple. So if you're selling a home for $1 million, you still are exposed to $500,000 in taxes. It doesn't matter what you buy on the replacement end, you're going to end up paying taxes.
Yes, that is very correct. And in the state of California, that happens very easily if you've been in your property 15 years or longer because of the rate of appreciation in the state. Even with $500,000 for a married couple, you can still wind up paying capital gains taxes on the sale of your primary residence. Okay, so what is the... Oh, we went through this, but we'll cover it again because I wrote it down. What is the general tax rate on capital gains?
20% federal, 13.3 state of California, 3.8 net investment income tax, which is Obamacare.
Okay, so we've hammered that down, and it's about maybe 37% total off taxes on your gain from the sale of your property. So, what are the legal ways a person can avoid or defer the taxes on the sale of real property?
Well, that's using the monetized installment sale or a 1031 exchange.
Okay, so let's look at 1031 exchange first. What is a 1031 exchange, and who does it apply to?
1031 exchanges only apply to investment property owners. It used to work for businesses, but that's no longer. You have to own actual real estate investments, so you cannot use this for your primary residence.
Okay, so how does it work?
On a 1031 exchange, once you're selling your property, let's say you're selling a property for $1 million.
Okay.
And it has a $200,000 loan on it.
Okay.
So you need to buy once you close escrow, that's when the clock starts ticking. You have 45 days to identify a new replacement property or properties. You can combine values.
Oh, really?
Yes. So if you go out and purchase a new property or few properties at $200,000 each, as long as the combined values $1 million, you're equal or greater.
Okay.
And then you have to take all the proceeds from the sale of your property, move it to the replacement property, and if you have a loan, in my example, I used $200,000, you must put $200,000 into the new replacement property in order to have a fully tax-deferred exchange.
So when you say put $200,000, if you have an investment property that's worth $1 million, and you have a $200,000 loan, and you sell it for $1 million, you pay off your $200,000 loan. You have $800,000 in proceeds in cash that you can go out and buy replacement properties. But you're saying that you need to invest the full $1 million. So does that mean you need to go and get another $200,000 loan and put that money into those replacement properties as well?
That's correct. And when you say you have to replace $1 million, technically you can reduce the real estate commissions and the closing costs that you paid on the sale. So you can go a little bit under $1 million. But the reason you need to replace that $200,000 loan is because the IRS considers that, we call it mortgage boot. And what happens is the IRS looks at, you paid this $200,000 loan with equity on money that you never paid taxes on. So when you pay that, they don't like it because they didn't get their tax money. So now you will get taxed on that $200,000 if you don't replace it.
That's crazy.
Yeah.
That is crazy.
They're going to get you in any way they can.
I got to tell you something, and it's totally off topic, but right? So you work hard, you go to school, you get a good job, you learn a few things, you keep performing well, you get promoted, you get bonuses, you operate on a tight budget, you save some money, you buy a house. Then you keep doing the right thing, and then you save some more money and buy an investment property. You get a loan on it, and you're doing this stuff so that you can improve your life for you and your family. And then when you go to pull the money out of your investment, it's almost as if you get punished for being successful in the United States of America. It drives me crazy.
Exactly. And when people get to retirement, they get hit with so many more taxes. That's why people are moving out of the state of California.
Yes, yes. And we're hoping to reverse that with strategies that we're talking about today.
Yes.
So, 1031 exchange. So, back on topic, I digress. We pull the show back into the lane. What are the specific steps one needs to take in order to execute a 1031 exchange? We touched on a couple. Kind of at a 30,000 foot level, but if you were going to walk someone through that had never done one before, how would you explain it to them so that they could understand the steps in order to get it done?
Well, first of all, you want to work with a real estate agent that understands what they're doing, and you know Stephen is that man for you.
Thank you.
So we work very closely together in our transactions, but basically, what you need to do is once Stephen finds you your buyer for your property, he's going to put in a clause in the purchase agreement that the IRS, it's very important. They want to see this. And you have to make the buyer aware that the seller is going to do a 1031 exchange and the buyer agrees to cooperate. Now, by cooperation, there's really no involvement with the buyer. It's just letting them know that the seller is going to defer the tax and they're aware of that.
Okay. So
there's no liability or to the buyer.
Right. So I've seen this when I've gone to represent a buyer in purchasing a home, and it's disclosed that buyer agrees to cooperate on a 1031 exchange. And my buyers ask me, what does that mean? And I say, basically, it's an investment property, and they're going to use the proceeds from the sale to buy another investment property, and they're going to be doing some maneuvering on their end. It does not affect you at all as far as you closing escrow. Now,
no
Mark,
cost, no liability, no delay in the escrow.
That's right. So it's just you signing off that and it's the seller following the IRS rules of notification. So it's basically a notification issue. So Marco says we have a minute, which probably means I'm down to 45 seconds, 30 seconds now, of course. So when we get back from the break, we're going to finish walking through what the details are in a 1031 exchange, and we'll ask a few questions about it, and then we'll move on to the really juicy part of the show today, which is deferring taxes on potentially your primary residence. All right, so when we get back from the break, we'll get more into this. Thank you for joining us this morning, and we'll see you in a minute. All right. So how many long segments we have left? 2 more. So in the next segment, we'll do the rest on 1031 exchange, or half of it, because how long do you think you're going to need for
not too long
for the monetized installment sale?
Who knows?
Who knows? All right.
You just tell me how much time I have. I'll make it happen.
All right. You got it. See, we're going to have her on again. I've had guests in here, I'm dragging it out of people. I'm like, really? Come on, say more. You're a natural. So great. We're going to definitely do this again, because this is one of those topics that I think you kind of scratch the surface on it, and then you can get into specific scenarios and different details in regards to kind of twists and plays on how it will work. And there's just tons of content here, and I think people out there would enjoy it. So we're going to spin this back up. Thank you, Marco. We're going to go for it. Hey everybody, welcome back to the show this morning. We're having a good time with Ruth Benjamin in studio today. We're talking about how to legally avoid the tax man when you're selling real estate in the United States and the state of California. Specifically for investors, we're going through right now with the topic of an IRS Section 1031 exchange for investors, and how to avoid taxes when you're selling your property, and what that means, the details of how it works, and we were going through that before we went to the break. So before I get too much more wordy on this, we're just going to jump back in with Ruth. So we were talking about the details on that. We were discussing that, first of all, the seller needs to get a realtor who understands how it works, and then they disclose that they're going to do a 1031 exchange to the buying public and to the buyer who eventually they get into contract with. And then what are the other steps after that?
Well, once the transaction closes, you're actually closing escrow. Then the seller has 45 days to identify a replacement property, and they have 180 days to close on one of the properties they identified.
Okay, so 45 days to identify and then 180 days to close. Does the 180 days start after the 45 or does it run
It
alongside?
runs from the close of escrow, so you only get the 135 days left after.
Okay, so this can be stressful because one, right, if as far as I understand from my limited experience in 1031 exchange, I've done a few and I understand the nuts and bolts, but this is why you have Ruth by your side as a technical expert to help keep you honest and straight and making sure that you're taking care of your clients. My expertise is in selling real estate. In doing that, you touch on a lot of different aspects of the industry, including investment properties. But when you go to name 3 properties, it's my understanding that once you choose those 3, if you don't get into contract on one of them, you can't replace one. So I named ABC Street and 123 Street and XYZ Street, and then 2 of those properties sell. I'm then stuck with the one, and if I don't get that one, I'm done, right?
Yes, technically you're done, but the IRS says you can go to the buyers of the ones that for the first 2 properties you identify and make them an offer.
So you can make them an offer.
Sure.
Right, but
But you cannot change after the midnight of the 45th day. Those properties that you identified. So, in the identification rules, there's 3 property rules where you can identify 3 with no value of the. Each one would have to be equal or greater, but you don't have to worry about value. But if
Okay.
you identify 4 or more properties, then you can't go over the total values of all the properties you identified. Cannot go over 200% of the property you sold. And if you do, then you hop into a 95% rule that says you need to buy at least 95% of the value of what you identified. It's crazy.
Holy macaroni. Okay. So, but no, this is good because I've just learned something here in this interview today because I was under the impression that you could only name 3. So now I know you can name more than 3, but that you can go up to 200% of the value of the property you sold in naming more than 3, which does give you a little bit more cushion as far as if those properties disappear out from underneath you by the time you get ready to write an offer on them.
Right.
And so if you go over 200% of the value, then you have to buy 95% of
the value of what you identified, of the whole combination of everything you identified. So we really have to work very closely together if what you're trying to do. I have a client that was trying to replace $8 million worth of property with $50,000 investment homes.
Are you kidding me?
I don't know how you're going to get to that point, but by the 45th day, he had to name them all or be under contract for $8 million worth of homes at $50,000 each.
So do the math. That's a lot of houses.
That's a lot of houses.
That's a lot of houses, and they're small, and each one of them comes with a stack of paper and a lot of time to get it sold. And there's uncertainty because in real estate, something can fall apart on you at any moment in time. So that creates a lot of exposure. Not my recommended path as far as being able to replace the property. So we've touched on that, and then so at that point you get into contract, you close escrow. What else is next?
Well, as long as you meet the 45th day is the real key. But what I'm finding with clients is they have identified a replacement property. Now they're coming up on their 180th day timeline, and they found out that the property that they identified had too much work, and the seller's not willing to do any money into it for the improvements, and they don't want it.
Okay.
So they're stuck.
What happens if you fail the 1031 exchange?
If you fail the 1031 exchange, the intermediary will release the money to you, and then you are going to pay your taxes.
Okay, so this brings up another question you touched on, something important. Intermediary releases the money. So when you sell your property, you don't actually keep the proceeds in your own bank account. Where does it go?
You cannot touch your money. That's called constructive receipt, and the IRS will tax you. You must use a 1031 intermediary in order to get the benefit of not paying the taxes.
So when you're selling your house, you set this up, or your investment property was not your house, your investment property,
right,
or your rental. You set this up through the title company so that when the proceeds of the sale come through title, it goes directly to the intermediary?
Yes, you can use the title companies have intermediaries, and then there's independents such as the one I work with
Okay.
out there that can also provide that service for you.
Okay, so the company you work with is again?
National 1031 Exchange Services.
And they are an intermediary,
They
correct?
are an intermediary, yes.
All right, so I'm going to throw this out there right now. If somebody wants to contact you in regards to more questions about this, how do they go about doing it?
The telephone number is 877-483-0427.
Again, that's 877-483-0427. And that's to reach Ruth Benjamin. If you are an investor and you're thinking about doing a 1031 exchange and you want somebody with 25 years of experience who's done this multiple times over her career to assist you through the process, and then of course she'll circle back around to me to help you with the sale on the real estate side. So okay, now let's touch on one other thing. There's something called a reverse exchange. What is that and how does it work?
A reverse exchange is when you found a property you want to purchase, but you haven't sold your property. So you can do that by, there's many different ways. You can get a loan or you can loan the intermediary money. They create an LLC that buys your replacement property. And then once you close on it, you have 180 days to sell. So if you don't sell that property in 180 days, you now own two.
Okay.
You cannot go back and unwind it. You own two.
Okay. So if you're thinking of replacing your investment property and it's been on your mind, and oh, I'm playing around. I just had somebody reach out live and say they're going to reach out to Ruth. Yay! Great.
All right.
Yes, so it's working. All right, so if you're out there and you're thinking about replacing your investment property and you're looking around and you see something but you're not ready to sell yet, you still can do it. There are mechanisms and ways that you can purchase your replacement property first and then go sell the property that you have, which can be of some comfort to you because you already know you have your replaced property. It just will be up to you to make sure that you get your property sold, which means you have to be a little bit more flexible probably on price. If you're thinking about getting a number and it's not happening, you have to make sure that it does happen. If you don't have the ability to carry two properties. So Marco says, I have how much time? 1 minute. So we're going to wrap up 1031s, and when we get back, we're going to talk about this new concept of an installment sale that can actually defer taxes on your primary residence. And I'm very excited to hear about the details of this because prior to having Ruth on the show, I had never heard about it. I've heard about 1031 exchanges and I've actually helped people do it, but in this regard it can actually help me, so I'm actually really interested in it myself, and I hope all you people who are listening today will stick with us when we get back from the break so that you can find out about deferring taxes on the sale of your primary residence, and we'll be back in a minute. All right. One last long one.
What?
We're doing
goes so
good.
fast.
Right?
We got so much to talk about.
I know. I know. Hey, Jeff, thanks for joining us. I posted your little not your little, but I posted your comment on the board. I'm playing with technology.
I'm looking forward to talking to you.
Yes, Jeff Sheets. He's a realtor that I know out of the Coldwell Banker office in Morgan Hill.
Awesome.
Awesome. Thanks, Jeff. We appreciate your support. Okay, so we're going to jump back into the show, and I'm going to skip a bunch of questions.
Right here, so let's talk installment
All right,
sales.
yes, thank you very much. Good eye, Ruth. Good eye, Ruth. I'm telling you right now, we're having Ruth back because we're just scratching the surface on this stuff today. Like I said, if you have more questions, call Ruth at 877-483-0427. Again, 877-483-0427. As a matter of fact, I'm going to pop that in right now in a text. 877. Oh, I'm sorry. All right, let's do that. I'm producing as I go. 877-483
0427.
0427. And we're going to add it. Where'd it go? There it is.
There it is.
I'm going to put it right there. How about we put it there between our heads?
Okay.
All right. Okay, there's the phone number in case you guys want to call. All right. Marco, I think we're ready to go. Hey everybody, welcome back to the show. Wow, we've been having a really good time with Ruth Benjamin in studio today talking about how to defer or avoid paying taxes on the sale of an investment property and how to defer taxes on the sale of a primary residence. So this is new to me. I'm going to give you the name of what it's called. It's called a monetized installment sale. So a monetized installment sale is a way that you can legally and approved by the Internal Revenue Service to defer taxes on the sale of your primary residence. How about that? That's amazing because we know in California you have a lot of accelerated appreciation in the market. If you've been in your house for 15 years, you may have accelerated past that $500,000 exclusion, and you're going to pay some capital gains on the rest of your proceeds. So let's talk about installment sales. What are the benefits of an installment sale or a monetized installment sale, Ruth?
Well, the benefit is you can sell your property today and not pay the taxes for 30 years.
30 years! Really? Okay, so like I'm 52. I'm giving away my age. I don't mind in this scenario. 52 years old. So if I sold my house, I wouldn't have to pay back any taxes till I was 82 if I was still around. Are you serious? That could be a lifetime for you if you're in the right age bracket, right? So let's continue because this is exciting to me. All right. So can you walk us through how it works?
So basically, once you have a buyer for your property, now, yes, this can work for primary residence. We have to talk to you. There's certain cases that could exclude you from primary residence, but we can talk to everybody to see where they're at. But so once you have a buyer for your property, then we have a capital asset dealer that steps into the transaction, much like a 1031 exchange intermediary.
I'll say, okay, so we have a capital asset dealer. I didn't even know these people existed, okay, until today. We have a capital asset dealer, okay, that steps in. Okay, what's next?
So the capital asset dealer creates an installment contract with you, the seller, before you close on your property. And that installment contract is for 30 years, interest only, because remember, you can't receive any principal or you're going to pay taxes.
Okay.
So interest only for 30 years. Is the installment contract. Okay, so they enter into that before you close escrow. Even though you have the installment contract in place, just like in a 1031 exchange, you're still going to deed your property to your buyer. There's no delay in the escrow. We're going to make sure everything flows very smoothly with you. So.
Okay, so one quick question.
Okay.
So I sell this to, what were they called again?
Capital asset dealer.
Capital asset dealer. It's going to take me a while. I'm learning new vocabulary. So you sell it to the capital asset dealer in an installment sale, and they pay you interest. Is that interest monthly or annually?
Monthly.
So you get a monthly check?
No, we're going to create escrows, but let me get to that.
Okay, all right. Okay.
So you now have an installment contract.
Okay.
And so let's say the installment contract's for $1 million.
Okay.
The capital asset dealer introduces you to a lender that loans you 95% of that installment contract, so $950,000.
Okay. So we have an installment dealer who is going to acquire the asset and then step in and resell it to the end user, the buyer, and they're going to pay you interest only for 30 years, and then they introduce you into a lender who then loans you 95% of that installment contract. So we're taking a bit of a haircut, but
a bit of a haircut is correct.
But
that tax bill's more of a haircut.
The tax bill's more.
They make you go bald.
Right. Versus a trim and a shave.
Just the bangs.
You get a full head shave. You get a Telly Savalas, baby. Have a lollipop. Okay. All right. Okay. So go on.
All right. So once the installment contract is in place and the lender, now the beautiful thing is, get this, you don't have to qualify for that loan.
Really?
No, you're not giving the lender any information about you or your social security number until the end of the transaction when they're funding your loan. So it's a no qualification. All
Wow.
right.
That's
So you get this loan. Okay. It's not what if.
okay. You just get it.
Right.
All right.
Okay, because remember my background also, I've done credit repair in the past, so people know me as a
Oh.
credit repair person.
Okay.
So I had
Fair
people
enough.
calling me and say I got to replace my loan and I don't qualify. Well, you don't need to anymore.
All
Okay,
right.
don't worry about that. That's not an issue.
Okay, so you got this guy that comes in, buys a property, sells it to another person, introduces you to a lender that you don't have to qualify for. You just get the loan, 95% of the 30-year installment contract. All right, go ahead.
All right,
Go ahead.
so you got this loan, and so basically what you've done is you swapped your sales proceeds for loan proceeds, and we all know you don't get taxed on a loan. So now you have your money in your pocket. Okay, you receive it. You don't have anybody else controlling it for you. It's in your bank account.
Oh, cha-ching.
Yeah.
So I get it. So you sell your house, you get it in contract, and then the
Capital asset dealer
takes it off your hands, steps in, transfers final title over to the buyer so it doesn't affect the escrow at all. And then he introduces you to a lender who lends you 95% of the value on that property. You get it all.
Loan proceeds.
Loan proceeds. You sign a note, you get it. Then how does that work for you paying that loan back?
Good question. That's the next step.
All right. I'm catching on. I think I see where this is going.
Yeah. So the beautiful thing is between the capital asset dealer and the lender, they have these escrow accounts. So not the escrow that closed your sale. They set up separate escrow accounts. And what happens, there's 3 of them. There's one for the dealer, there's one for you, and there's one for the lender. So in the paperwork, it states that the dealer's going to make the payment into this escrow, and the escrow automatically flows to you and then you to the lender, so it pays every monthly payment. You will never take one dime from the money you got in your bank account to pay this loan, ever. And then in 30 years, the dealer puts in the 95% to pay off the loan. It runs through the lender, and guess what? Now you have constructive receipt, and now is when you're going to pay your tax bill.
I see.
And there's protection. This is the beautiful part of the whole thing. In the paperwork, it says if the dealer doesn't make the payment on time, the lender cannot come after you. They cannot touch any of your other assets. They can't issue a 1099-C, and they cannot put anything negative on your credit report.
Oh, that's amazing. That's amazing. So, this is like you're setting up a money moving where you don't have to worry about paying this loan back because you've got an installment sale that's paying you interest. The interest is going to match what identical to the interest that you would be paying on the loan you received. So the installment sale pays you interest, it goes into an escrow account, and then it moves into your hands for a second. You don't touch it, and then it goes back out the door to pay your interest on your loan. So in this circular...
And it technically doesn't go to your hands. It's in an escrow. So you haven't touched it.
You haven't touched it. It's just in your name.
Right. And the key is the payment to you on the interest and the payment to the lender, they make sure it's the same so it washes out. Now, you will have to report on your tax return that you received the interest. They give you the 1099 INT.
Right.
And then the lender gives you a statement that says that you paid the interest so you can write it off. And the reason you can write it off, it's because it's a business investment loan. And that's where the primary residence, we have to talk about how to work it because it's a business investment loan. You need to use it for business or investment. So the beauty of this is that if you have other investment properties, you're an investor of multiple properties, you could sell this one and pay off the mortgages on the other, which is something you cannot do in a 1031 exchange.
You cannot do that. But the question is, can you take this loan that you're getting and use it to buy another primary residence?
Well, you cannot use these loan proceeds to buy another primary residence, but you can use other money that you have. So let's say you have a 401k or an IRA or something that has the money. You buy the new residence with that.
Okay.
Then you take this money and put it back into your IRA. That's an investment.
Oh.
So that's why I need to talk to each person on how to structure it.
So depending on what type of investments you have or hold, you could use this as a vehicle to structure deferring taxes on your primary residence and buying another primary residence if you have your personal situation can fit. However,
Right.
if you're an investor and you're looking to use your primary residence to pay off other investment loans and things of that nature,
It's a no-brainer.
then it's
It
an
works
absolute.
for all investors.
Oh my Lord, this is absolutely fantastic. I got to tell you something, Ruth. Today I have learned a ton, and I feel like I've just barely scratched the surface. And I have Marco in my ear telling me I only have a minute, which means I have 30 seconds, and I got to wrap up this segment, which is the last one. And then we'll come back and kind of do a 30,000-foot flyby to kind of give a wrap up for the whole show. But I'm going to ask you right now to come back. Would you do that?
Of course.
All right, so we're going to have her back again because I think we need to dig into this a little bit deeper. So I hope you'll stay with us, and we'll be back when we get back from paying some bills. Woo, that was close. I was skating in. Thanks, Jeff, for your support. This is awesome. This is awesome. I've learned a ton. So we're going to jump into the last 5 minutes here and kind of wrap the show and kind of give a recap. As I was told, tell them what you're going to tell them, and then tell them what you told them.
Right.
So that's what we're going to do.
You're going to tell them what you told them.
We're going to tell them what we told them. All right, so we're ready to go. That's right. We're boogieing in studio. Hey, everybody. Welcome back to the show. Thank you again for joining me this morning with Ruth Benjamin. We've had in studio talking about 1031 exchanges and avoiding the tax on the sale of investment property and deferring the tax on the sale of a primary residence to maybe use to buy a new primary residence, but definitely to use for business proceeds to invest in, to pay down other debts on your other investments. So we're just going to recap the show and kind of give a summary, on 1031 exchanges and the monetized installment sale. So Ruth, I'm going to let you take it from here.
All right. So remember, 1031 exchanges have crazy rules. Even if you're in a partnership, you cannot drop and swap is what they call it in exchanges, but you can do this with monetized installment sales. On 1031 exchange, when you buy and sell properties, your cost basis moves with the property. So you can actually run out of depreciation on a 1031 exchange if you're an investor of many years. Monetized installment sale gives you the option to get your full 27 and a half years or 39 years back.
Ooh, wow.
Your depreciation schedule. So I know I've given you a lot of information today.
Yeah,
and you just have to have my phone number so I can talk to you.
Yes, 877-483-0427. Again, Ruth?
Benjamin.
877-483-0427. So that's interesting. You just talked about something that just flew right over my head because I'm a tax guy. I have a degree in business and accounting, and I did taxes for 10 plus years. But we talk about depreciation. So on a 1031 exchange, you just touched on you run out of depreciation. Can you explain that a little bit more in detail?
Yes, if you're an investor, you're investing in single-family residences. Okay. So you get 27 and a half years to depreciate that property.
Okay.
Well, if you're an investor of 30 years, your investment has done no good for you. Even if you bought, sold in a 1031 exchange, you're done. You're wiped out. That investment's no good for you anymore.
So your depreciation is gone. You don't get it. You don't get to fill the tank back up with depreciation again when you go to that next property. It's just depleted, and no matter what, because it's married to the very first property you purchase. Oh,
and
my
your
Lord!
Taxes are married to the very first property you ever bought. So if you go to sell 30 years down the road, your cost basis is the very original property you bought at $17,000 or $25,000, and you got to pay all that back.
And you have all of that depreciation recapture that you have to pay the IRS at what percentage rate?
25%.
25%. So if you bought $1 million asset and you fully depreciated it, that's 25% of $1 million.
Yeah, right off the top.
Right off the top. That's insane. That is nuts. All right, so Marco says I have 2 minutes. So this whole monetized installment sale is a wonderful thing. It's a beautiful vehicle. It's really legal. There's IRS decisions, memorandums on it. It was put in place. We didn't get into the history. I was going to try to get into
installment sales have been around since 1913.
Okay.
And in 1980, Congress said you could take a loan out on your installment sale contract and still get tax deferral. Since 1980.
So Congress has voted on it, folks. So
453 is installment sales, section code 453. 453A says you can take the loan on your installment contract.
Okay, so that makes this available for people to use. All right, so I hope you guys have enjoyed the show. Thank you very much, Ruth Benjamin, for being on with me today. It flew by. Great guest, and I hope everybody out there enjoyed the program as well. If you have any questions or want to speak to me directly, send an email at info@realestateconnectionradio.com. That's info@realestateconnectionradio.com. We'll be back again next week at 8 a.m. Saturday morning on KFAX 1100. I don't know what the topic of next week's show is. God always sends it to me at the last minute. But I'd like to thank Ruth personally for joining us. God bless you, Ruth.
Thank you.
God bless you all for listening today. God bless the state of California. God bless the United States of America. And thank you for joining us. Enjoy 2020. It's already started off being great. The economy is on fire. The USMCA has been signed. And jobs are everywhere. There is not going to be a recession in 2020. We will see you next week. All right, people. Thank you for joining me live today. If you like today's show, share it. And if you're listening on YouTube or watching on YouTube, hit that like and subscribe button. Hit the like and subscribe button, and we'll be doing these once a week for sure for the radio show. And I'll be doing some lives on Fridays, little market updates and things that I see that are occurring in the real estate market that I think you might want to know about. All right, thanks a lot for joining me, and we'll see you guys later. All right, take care.
Bye-bye.
Bye-bye.